going to continue with our previous discussion of amalgamation. What is basically amalgamation and how the accounting is done. So this is a part of your module 7, and next module is going to be your I think holding and subsidiary concept, which is you can say a kind of extension of this chapter only. Okay, so we'll just give a quick recap of what is basically amalgamation. So amalgamation is when like two or more companies, they come together and they form a single entity, and they going forward they continue their business as a one association. So under your amalgamation, two or more companies, they result in the creation of a new company, and it is the consolidated organization of the participant companies. And in amalgamation, the assets, liabilities, and operations of the merging companies, they are integrated to form a new and larger entity. So this process is often undertaken for strategic, financial, or operational reasons. Just a second. Okay. So because of amalgamation, there are multiple benefits which comes to an organization. It can be strategic benefits, financial benefits, it can be operational benefits. Like the biggest benefit is your economies of scale. So what happens in economies of scale, that when you are doing business in you can say uh, on a large level, when multiple organizations have come together and formed a single association, so economies of scale occurs when companies they merge. So basically your cost is reduced per unit by increasing production and utilizing resources more efficiently. Just a second. Just a second. So, we were talking about that when amalgamation happens, it results in various benefits to the combination of these organizations. They expand their market presence. Their overall efficiency is improved. They get economies of scales. So basically, what happens in economies of scale is that the per unit cost it reduces when you are producing in a large quantity, and definitely you will be able to utilize your resources more efficiently. So economies of scale will happen in the manufacturing plants also, in your distribution networks, your IT infrastructure and administrative functions. So this basically leads to lower cost due to bulk purchasing, reduced operational redundancies, and improved bargaining power with suppliers. Okay, so that's one thing. Then you get synergistic benefits also. So synergistic is like when two or more individuals or associations they come together, they give a greater value. That means if association A is bringing benefit of benefit of $10, association B is bringing benefit of $10, and association C is bringing benefit of $10. So overall, it should be $30 when they are together. But if we see the actual benefit which is generated in that A combination of A plus B plus C, it will be somewhere around 40. So why it should be 30? So it is because that when things combine, they make some extra benefit. Okay, so that is the thing, that is basically synergy, which occurs when two companies they combine and they create value greater than the sum of their individual values. Okay, so synergies can be like your operational synergy, revenue synergy, like under operations, your overall operations or the processes, they become more efficient. Okay. Then in case of revenue synergy, you have a better market share, your sell products value is increased, your customer base is expanded, all of that happens. Then under financial synergy, you have better financial management, lower cost of capital, and optimized tax benefits. So this is the thing, operational synergy, revenue synergy, and financial synergy. But the merging firms, They can combine best practices, eliminate redundancies, and increased efficiency in production and marketing. Okay, so all of these are the basically the benefits of amalgamation. Now, amalgamation, there are basically two main types of amalgamation. It can be merger and it can be absorption. So, in a merger, two or more companies they agree to join forces and operate as a single entity. So, the merging companies pool the resources and shareholders of the merging entities. They become shareholders in the new merged company. That means A and B, if they merge together, it will be AB. Okay. In absorption, if A and B are getting absorbed, that means there will be one association who is absorbing the other, or the other two, or the other three. So, for example, A is a bigger association, B is a smaller association. They're getting absorbed. So that means eventually it will be A only because B has already been absorbed, included in A. Okay, so that is absorption. So there is a concept of merger and absorption. Okay, so in a merger, two or more companies they agree to join forces and operate as a single entity, and the merging companies pool their resources, and shareholders of the merging entities become shareholder in the new merged company. Okay, so amalgamation in the nature of merger. Okay. So what happens in amalgamation in the nature of merger? Two or more companies they consolidate to form a new entity, and the identity of one or more of the amalgamating companies is preserved. Fine. So the thing is that is what I was telling you, that if A and B, A association A, or you can say company A and company B, they merge together. That means the our final outcome will be A B company, okay, or ABC company. Okay, so that your identity and your assets will be preserved. Okay, then the business of the amalgamating company is continued without any significant changes. Then the assets and liabilities of the amalgamating companies they are transferred to the new entity at their book values without any adjustment. Then no transfer at fair values. Then identity of one or more companies is retained. Then no adjustments to book values of assets and liabilities. Now the thing is that for subjective questions, you should prepare these questions like write 5 points on amalgamation and the nature of merger, or give a brief note on amalgamation in the nature of merger and nature of purchase. Okay, so this is how you should prepare it. That at least these 6 lines you should know for theoretical reasons, theoretical questions. Okay, so at least prepare these 6 lines, more than enough for you. Then accounting treatment. So what happens in the nature of merger? That first of all, transfer of assets and liabilities that will happen for sure in both, in purchase, all in nature of purchase also, in nature of merger also. Okay, so the assets and liabilities of the amalgamating companies they are transferred to the new entity at their book values without any adjustment to fair values. Okay, then we have treatment of reserves and surpluses. So reserves and surpluses of the amalgamating companies they are treated in accordance with their nature. Then general and free reserves they are typically transferred to the reserves of the new entity. Then continuation of identity. So the identity of one or more companies is retained and the business continues without undergoing substantial changes. Fine. Then treatment of shareholders of the amalgamating companies. So shareholders of the amalgamating companies, they become shareholders of the new entity in agreed upon proportions. Fine. You will understand all of this when we solve questions. So don't worry. It is like amalgamation is something when you solve questions, then only you will understand. Okay. So amalgamation in the nature of purchase. So these are some key features with respect to amalgamation and the nature of purchase. So in this, one company acquires the assets and liabilities of another company, and the acquired company may cease to exist. So there is only slight difference. Just a sec. Okay, so we were discussing this amalgamation and the nature of purchase. So what happens is one company is purchasing other company. Okay, so you understand it in this way that if it is being purchased, that means one company will pay some money to the other company. So what is that money which is being paid to the other company? It is the consideration. It is known as, or you can say precisely that it is purchase consideration which is paid to the shareholders of the acquired company. So the assets and liabilities, they are recorded at fair values, and any excess of consideration over the net assets acquired is recognized as goodwill. So transfer at fair values, then acquired company may cease to exist. Then recognition of goodwill if consideration exceeds net assets acquired. Okay, these are basically the difference. Yes, these chart for differences is going to be very helpful when you are preparing examination. Okay, so you can, I think, I have discussed all of this yesterday, but it is more or less similar to what we have discussed, transfer of assets and liabilities. Yes, this E point, recording of assets and liabilities. So what happens in the nature of merger, the assets and liabilities taken over recorded at their existing carrying amounts. Now, what do you understand? Any idea? I think one student is there. Do you understand what is the existing carrying amount or what is the carrying amount? What is the carrying amount in terms of accounting? Any idea? No idea what is existing carrying amount? So existing carrying amount is very, you should know because for as accounting students, it's very important to know these basic things. Carrying amount is the book value, present book value which is in the books. Like what is the value of that particular machinery in the last balance sheet or the current balance sheet. Okay, so that is your carrying amount. So the assets and liabilities taken over are recorded at their existing carrying amounts, except where adjustment is required to ensure uniformity of accounting practices. So the assets and liabilities taken over are recorded at their existing carrying amount or the basis of their fair values. Okay. So then method of accounting, the journal entries for recording the merger, they are passed by pooling of interest method, and in case of merger, and in case of purchase, it is recorded by the purchase method. These are two methods. I will tell you what each of the methods will explain. And just to give you a short recap, that amalgamation, when companies are merging together, okay, in the nature of merger, purchase when another company is taking over that company. Okay. So let's move ahead. Hmm. Now, what is purchase consideration? Have you ever heard this term, purchase consideration? What is purchase consideration? No idea, students? What do you understand by purchase consideration? So basically, when one company is purchasing other or merging with another or acquiring the other company, so there is something which you need to pay to that shareholders of that company for that takeover. Okay, so that is basically your purchase consideration, which refers to the total value which is paid by the acquiring company, which is the transferee, to the acquired company, that is transferor in an amalgamation or business combination. So it includes the fair value of assets given, liabilities assumed, equity instruments issued, and any other forms of consideration. So that is purchase consideration. Fine. So when you are giving this purchase consideration, it can be in any form. It can be in cash, it can be in the form of equity shares, it can be in the form of preference shares, debentures, or it can be a combination of above. Like for example, if the purchase consideration is 50 lakh, so some 25 lakh is paid in cash, some 10 lakh is paid in equity shares, and the remaining is paid in the form of debentures. So it's what has been agreed upon. Okay. So purchase consideration, it is the amount which is paid by the transferee company to the transferor company's shareholders in exchange for acquiring its business. Okay. So there are certain questions also which we are going to solve for purchase consideration. So purchase consideration can be computed in these various methods. There's net assets method. So in this method, the purchase consideration is determined based on the fair value of the net assets acquired. Okay. So net assets include assets, liabilities, and reserves. Okay. Then your purchase consideration will be equal to, like you can see this formula, fair value of assets minus fair value of liabilities and uh, minus fair value of reserves. So this is basically your purchase consideration. Now, if a company has assets worth rupees 500, liabilities of 300 and reserves of 50, so the purchase consideration would be 150. Okay, 500 minus 300 minus 50, it's easy. Then there is a net payment method of purchase consideration. So this method involves calculating the difference between the purchase consideration and the net assets acquired. So it can be purchase consideration minus fair value of assets minus fair value of liabilities. Okay. Net, what is basically net assets? Net assets, it's total assets, fair value of assets minus fair value of liability. So that is net assets. Then you compare that net assets with the purchase consideration. Okay, so that will become your net payment. So you can see if the purchase consideration is 200 and the fair value of assets is 180 and liabilities are 30. So what is net assets? 180 minus 30, that is 150. So purchase consideration 200 and 150, that will be 50 rupees. Okay. Then equity shares exchange method. So in cases where the consideration is in the form of equity shares of the acquiring company, the purchase consideration is determined based on the agreed exchange ratio. So we have purchase consideration, which is equal to number of equity shares issued by acquiring company into market value per share. So if the acquiring company, it issues 1000 shares with a market value of 10, the purchase consideration would be 10,000. That is 1000 shares into 10 rupees. Fine. Then the next is your pooling of interest method. So in case of merger, your pooling of interest method is followed. Okay. So what happens? This method is only and only used in case of your merger method only. So the pooling of interest method represents an accounting approach applied in scenarios of amalgamations characterized by the nature of merger, where two or more entities unite to form a new consolidated entity. So this method holds particular significance in the realm of corporate accounting, serving as an alternative to the purchase consideration method. So there are multiple entries which you need to understand for this pooling of interest method. Although the entries are very easy, you can see these entries. There The volume is high, but the entries are very easy. I'll just explain it to you, don't worry. Okay. So pooling of interest method. Let's see the entries. So the number one entry, when you are purchasing that business. So when you're purchasing anything, what do you debit? You debit purchase account. So similarly, you will be debiting business purchase account because you're purchasing a business. Okay. So business purchase account debit to liquidator of transferor company. Why liquidator? Because that company is getting dissolved, liquidated. You have studied earlier in our previous session, in yesterday's session also, that when a company is dissolved, it is when it ceases to exist, there is a liquidator appointed. So that company will have a liquidator. Fine. So now, if you are purchasing a business, first of all, you are going to debit business purchase account because it's a purchase, anyways. Okay. Then you are going to credit either cash because you are either paying cash or paying bank. But in case of liquidation, the liquidator will be the single point of contact for that entire process. So you are going to credit liquidator. Now, whatever money you need to pay, you will pay to that liquidator. That liquidator, what will do? He will sell off all the, he will receive it, he will sell other assets also, then he will pay the entire amount to in the preferential order, if you remember, if you're there in the last yesterday's session. So this will happen in that liquidating company. Okay, so whenever you are recording business purchase, you will do it like this: business purchase account debit to liquidator of transferor company. Okay. So this entry should be made at purchase consideration amount. Now for recording the assets and liabilities taken over, debit balances of assets is more in comparison to liabilities. So when you are recording the assets and liabilities, there will be a scenario that assets are more, liabilities are less. So anyways, it's a good situation. Okay, it's a favorable situation. So sundry assets, whenever you're taking over the assets, you are going to debit those assets in our books. So sundry assets account debit to sundry liabilities, to provision for doubtful debts, to profit and loss, and to reserves account, and to business purchase. Now business purchase is this amount only, which you have debited on the first entry. Okay, and the remaining are the liabilities which you have taken, and this reserves. So reserves is like a balancing figure. Fine. I'll tell you once again. Sundry assets, the exact assets at which you are taking up the company, all the assets, then all the liabilities. Then you will also credit business purchase, which you have earlier debited. Now you are crediting it in the second entry. Now whatever balancing figures comes in this entry, you will post it to reserves account. Is that clear? Okay. Now on the contrary, if the assets which you have taken, they are which are sundry assets are less and liabilities are more. So in that case, assets debit, liabilities credit, provision for doubtful debt to business purchase, and then eventually your balancing figure will come on the debit side because your debit side is a short side. Okay, so sundry assets, so profit and loss account will always come in that scenario in the debit side. So the name will be termed as profit and loss only. And when your assets are more, liabilities are less, as it happened in the second entry, the balancing figure will be reserves. Okay, so when you're revising all of this, please also go through these remarks. I've written the explanation. Okay, so uh, 2.1, it is saying that difference is adjusted in general reserve, being the balancing figure, and assets and liabilities will be considered at their book value. Then differences is adjusted in profit and loss account, being the balancing figure, and assets and liabilities will be considered at their book value. Then payment of purchase consideration. So liquidator of transfer companies, to share capital account, to securities premium account, and to bank account. Basically, you are paying that purchase consideration like at whatever amount you have taken that company. So you can see you are basically debiting the liquidator's account now, which you have created at the time of first entry. You've credited over here, now you're debiting it, and then you're paying it in the form of whatever consideration you are giving, shares, cash, or issuing shares at a premium, whatever it is the case. Okay, so liquidator of transfer companies is going to be debited, and then your three accounts will be credited. Okay. Then fourth point says payment of liquidation expenses by a transferee company. So we have general reserve account, which is debited, then two bank account. So general reserve account. So basically you are first of all paying liquidation expenses. So liquidation expenses that will always be debited from your reserves account, general reserves account. Okay. So general reserve, because they are eventually they are saved for these sort of purposes only. They are not for general uses. But general reserve can be used in case of exceptional situations where you need to pay off the money. Okay. For uncertainties or for any sort of unexpected any expected expenses which come to the company. Okay, so for the formation expenses of the transferee company, preliminary expenses account debit, excuse me, preliminary expenses account debit to bank. So formation expenses paid by the transferee company. Fine. Then settlement of mutual indebtedness among transferee and transferor company. So we have sundry creditors, we have sundry debtors. So you are basically, because these are like, what is basically mutual indebtedness? That for example, company A and company B, they are amalgamated. Okay. But in my books, company A is a debtor or a creditor. It can be either case. And in that company, obviously, I'll be a debtor or a creditor. So when both the companies are merging together, now you don't need to pay because you have become a one single association now. So there is no, you will basically knock off all the sundry creditors and debtors. Fine. So your sundry creditors will be debited and sundry debtors will be credited. Then we have purchase consideration method. So the purchase consideration method is a significant accounting approach employed in particularly when the nature of the amalgamation lean towards a purchase rather than a merger. So this method represents a departure from the pooling of interest method, and it is characterized by its meticulous consideration of the fair values of assets and liabilities acquired in the process of amalgamation. Okay, so you can see the entries, very easy. When you are recording purchase of business, so business purchase account debit to liquidator of transferor company, same entry, okay, which we have done earlier. So this entry should be made at the purchase consideration amount. So for recording the assets and liabilities taken over, so we have debit balances of assets, which is more in comparison to the liabilities. Okay, so sundry assets account debit, two sundry liabilities, and two business purchase. Fine. Then on the debit side, we'll be having goodwill because your asset is basically that's the adjusted value you can say. Okay. I think all of these entities are very similar to what we have discussed in the that method. The only thing is these entries. Payment of liquidation expenses of transferee company, goodwill or capital reserve account to bank. Then formation expenses of the transferee company. It can be preliminary expenses account debit to bank. Then accounting for statutory reserves. That is going to be amalgamation adjustment account to statutory reserve. Recording statutory reserve transfer company. Okay. I think you will better understand these entries when we're going to solve it through a practical question. Just give me a second. First, we'll solve a practical question. Just give me a moment. I'll share a question with you and then we'll solve it. Okay, so I'm going to share my Excel sheet with you. Are you able to see the blank Excel sheet right now on the screen? Okay. 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 So you can see one question on my screen. X Limited acquires Y Limited. Okay. So the purchase consideration is agreed upon as follows. X Limited will issue 40,000 equity shares of rupees 25 each at a premium of rupees 15 per share. Now, X Limited will assume Y Limited's outstanding liabilities amounting to rupees 3 lakh. So you have to calculate the purchase consideration. Fine. So first of all, we have to see what is purchase consideration. It is the sum of the value of shares issued and the liabilities assumed. Okay. The number of shares which are issued, number of shares issued. So number of shares issued is 40,000. Okay. Okay. The face value of each share is how much? Rupees 25. And you are issuing it at a premium. Okay. The total price will be 25 plus 50, 40. Okay. So you are giving each share at what? 40 rupees. So total value of shares, total value of shares will become 40,000 into 40. 40,000 is the number of shares and each share is valued at 40 because 25 is the face value and there's a premium of 15 rupees. You remember that premium concept from accounting from share capital, which we have done, I think. Unit 5 was there. In Unit 5, we have basically done this accounting for shares and everything. Over there, we have studied this concept of premium. Okay. So number of shares issued is 40,000 and total value of shares will come out to I think 16 lakhs. Okay. Then X Limited will assume Y's limited outstanding liabilities. Okay. So you are giving shares of this much and then you are saying that okay, we are going to pay your liability also. So liability is assumed. Liability, that is how much? 3 lakh. So your total purchase consideration comes out to rupees how much? It comes out to rupees 19 lakhs. Okay. Okay, so that is um your total purchase consideration. Were you able to understand this question, this example? Any difficulty in understanding this concept? This concept is slightly different from your other units, but not that difficult. Anyone who wants to understand it once again? Sahar, Karima, if you have any doubt, please let me know. If you have any questions, any doubts, please let me know in the chat section. But were you able to understand this concept? If not, then we will move ahead.
No, ma'am.
Okay. Just give me a second. I will share one more question with you. Now we'll basically solve a full-fledged question. Just a second. Um, Just looking for a question which includes most of the concepts. It becomes easier for us because we will do one question and then most of the concept will be revised. Little bigger question, but that's okay. That will help you in understanding all the concepts in one go. Okay, so please be attentive. Uh, you can see this question on my screen. Can you see this question on my screen? Please confirm. Then we'll proceed.
Yes, ma'am.
Okay. So you can see this question. The companies A Limited and B Limited operating in similar industries, they opted to merge and establish a new entity which is named AB Limited. So the newly formed company, it assumed ownership of the assets and liabilities previously held by both A Limited and B Limited. Okay. So given that assets are realized at their recorded values, now what will be the distribution of amount for each company? We have to draft an amalgamated balance sheet. We have to record relevant journal entries as per the given data. So this is the financial position, or you can say this is the balance sheet of the two companies which are amalgamating. One is A, one is B. Okay. So you can see these entries. So so what should be our first step? Any idea? What should be our first step? Our first step will be calculation of purchase consideration. Calculation of purchase consideration. Okay. So details of assets taken over by Asset AB Limited. Okay, so a new company. We were having A company, we were having B company. Now we are going to have another company which is known as AB company. Okay, so first we need to compute the net assets of both the companies, right? We'll just make a schedule. Particulars, simple, no complicated format. Particulars, hmm, then A Limited and B Limited. Hmm, hmm. So let's one by one we'll see what are the assets of these companies and we'll compute the net assets. So the first is your goodwill. You can see in the balance sheet over here. I'm just solving it parallelly. Okay, so that it is easier for you that from where the figures are coming. Goodwill 45,000 and 30,000. That's right. Goodwill 45,000 and 30,000. Then building, then machinery. That is 27450. Okay. Then inventory 24,000 and 17,325. Okay. Then trade receivables, all the assets. We are going to consider all the assets unless it is specified that you're not taking that a particular asset. We assume that everything is being taken off. Okay, trade receivables, then your balances with bank. Okay, goodwill, building, machinery, inventory, trade receivables, and bank balances. Fine. Let's have a small total over here for all the assets. Okay, so this is the total 1,24,500 for A Limited and 78,000 for B Limited. Right? Then we will consider the liabilities which are taken over by AB Limited. Okay. So under liabilities, it is only trade payables. So we will have trade payables. We have 4,500. Just a second. Yes. So we were discussing that what is your this um liability. So we have trade payables 4,500. Then your for A Limited and for B Limited we have 3,000. Okay. So your net this net assets, you can say, that is how much? That is your, you can say, we will just have a difference. Oh, why it is negative? This should not be negative. Okay, so your total assets were 1,24,500, and then we will deduct its liabilities, which have been taken over. So net assets, or you can say over here, the net assets is your purchase consideration also. So that is this much. Okay. Hmm. So this part is clear to everyone. Now we can we start with the journal entries.
Yes, ma'am.
This part is clear, na? But actually, your entire chapter is very easy. The only thing is you need to practice. Practice because you should know at after what you have to do what. Okay. So first of all, you need to calculate the purchase consideration. We have done it. Now we are going to pass record entries in the books of the company which is yeah, the final company you can say. Okay, or the company which is purchasing that A, B and B company. Okay, so let's pass the you can say in the books of A, B company, the final company. Okay. The first entry. First entry, we remember that it should be business purchase because that company is purchasing. When you're anyways, you're if you're purchasing, you have to debit it. Business purchase to liquidator of, because two companies are there, liquidator of A Limited, hmm, liquidator of A Limited, and similarly liquidator of B Limited. So how much you are going to pay to the liquidator of A Limited? You can see it in from the purchase consideration working. To A Limited, you are going to pay 1,20,000. This is the purchase consideration. That is going to be 1,20,000. Then for B Limited, it is going to be 75,000. So the total amount will be 1,20,000 plus 75,000. That is 1,95,000. Okay. So business purchase account debit to liquidator of A Limited and to liquidator of B Limited. Fine. Then you're going to record all the assets which you have taken. So one by one, you can take all the assets like your goodwill, building, machinery. So in one entry only, we can make this entry. What we can do is we can have a total over here. Otherwise, you have to make two separate entries. Just copy. Okay. So this much here. Sorry. So you're going to record these entries. Okay. These entries and the trade payable. So let's record it. Hmm. So you can see this is the first entry. Let's write entry number one. Solving entries in Excel format is a little bit challenging just to adjust the format and everything. It becomes really time consuming. Okay. So business purchase account debit to liquidator of A Limited and liquidator of B Limited. Then you are going to record all the assets. So goodwill, building, machinery. I'll just copy it from here. In examinations, you have to write. Cannot do copy paste in examination. Okay, good. All of these account debited. Okay. Then two trade payables. What is going to be the amount? Total amount. This. Okay. And under payables, it is going to be 7,500. Okay. So we have a total of 75,000, 41325. Okay, fine. This is okay. Then what is your purchase consideration? It was your 1,95,000. So that we are going to write over here to business purchase. You can see in the first entry we have written it 1,95,000. So it will become 1,95,000. Fine. Now you'll see if the entry is balanced or not. On the debit side, it is how much? Why my Excel is not showing the total? So out of all this, we have to, I think it's balanced. Let's see the total over here. It is 2,02,500 and uh, so your entry is balanced. No need to have a balancing figure because anyways you are taking the purchase consideration as per the net assets value. So that is where there is no difference. Okay, so the first entry when you're recording the purchases, second entry when you're actually taking the assets of that company. Okay, and then we will finally prepare a balance sheet as per this thing that you will be having goodwill, building, machinery. You will create a small balance sheet. I will show you what kind of balance sheet you are going to prepare. You're going to make a balance sheet just like this. Goodwill 75,000, building 15,000, machinery 47,625, inventory, okay, 41325, then your trade receivables, bank balance, and on the liability side, you'll be having 7,500 and this 19,500. This is your share capital, the purchase consideration. Okay, and your balance sheet will eventually tally. Okay, so that is your basically, this is a very basic way of recording amalgamation of companies. Okay, any doubt in this question? Is it clear, or you want me to help you in understanding any of the concepts again? Any doubt, any question?
No,
Any
ma'am.
doubt? Okay, fine. So we'll take a break for 5 minutes, 7 minutes, and after that we'll continue with our discussion. We'll start with another question also, and then we will proceed with module number 8. Okay. So we'll take a break for 5 minutes. You guys also can take a break. बंदर यहाँ पे बहुत दिन से पड़ा हुआ है नीचे। जो मैंने 2 मिनट का ब्रेक ले रखा था, नहीं तो आप आ जाते पीछे। Hello. Hello. I hope you're there. Back from the break. Okay. So, we were discussing, uh, just a second. So that question is clear to everyone? That question for amalgamation of company A and company B into AB. The entries are clear. Let me share my Excel sheet. So most of the questions will be on this pattern only, where you will be given data for two companies, A Limited and B Limited, or any other two companies. Okay, and the financials will be given of that those two companies. It will be explained to you like what is going to be the purchase consideration. You will calculate that purchase consideration. After step one will be calculation of purchase consideration. Step two will be recording of journal entries in the books of the final company. Okay, you will be recording it as a purchase, like business purchase account debit to liquidator. Now, since there are two companies over here, we have company A and company B. So, liquidator of A Limited and liquidator of B Limited. So, you are going to merge them, and then finally, you will be having this entry, goodwill account debit, building, whatever assets are there which you have taken from that company, those assets. Then on the liability side, you will be entering all the payables and liabilities and provisions, whatever you have taken. Then the purchase consideration, that is going to be on this credit side only, to business purchase. You're reversing that business purchase account. Okay, and eventually your this amalgamation will be done, and you will going to prepare the final balance sheet, which will somewhat look like this. Okay, so that this is a basic example of amalgamation of companies. Let's do one more question. Let me have one more question which is easier for you. This is a slightly bigger question, but no worries. If the question is big, that will actually help us to understand more concepts in one question itself. Okay, give me a moment. I'm going to paste that question on the Excel sheet. Can you see the question? Can you see the question on the Excel sheet? Please let me know. Anyone? I can understand it's a Sunday morning. Very tough for all of you to attend the class, but that's okay. That's the last class. Okay. So, hmm. So let's see. The following is the balance sheet of P Limited and Q Limited as of 31st of March 2023. So you can see there are so many assets, so many liabilities in their individual balance sheets. So plant and machinery, land and building, inventories, trade receivables, cash and cash equivalents. Then we have equity share capital, and then we have trade payables, we have debentures, general reserves, statutory reserves, and your profit and loss account. So that is all there in the balance sheet of P Limited and Q Limited. Now this is basically the information given that P Limited has taken Q Limited. That is P Limited is taking over BQ Limited, or absorption. This is a case of absorption. Okay. Amalgamation is in the nature of purchase. The debentures of Q Limited will be taken over by P Limited and then converted into an equal number of 9% debentures. Then P Limited will issue 28,125 equity shares of rupees 10 each at par to the equity shareholders of the Q Limited. Okay, so uh, this is the case that the following is the balance sheet and these are the conditions, and it is said that Q Limited debentures will be first taken over and then they will be paid equal number of 9% debentures. Okay, and then P Limited will issue 28,125 equity shares of rupees 10 each at par to the equity shareholders of the Q Limited, and P Limited will also issue 125 preference shares at par to the preference shareholders of Q Limited. We have to prepare journal entries and record the amalgamation in the books. Okay, let's quickly start solving the question. So first we will, what we are going to do, we will start recording start calculating the purchase consideration. So we will write calculation of calculation of purchase consideration. Equity shares, 281250. How I have calculated 281520? You can see this last point. P Limited will issue 281525 equity shares of rupees 10 each. So 28125 into 10 to the equity shareholders of the Q Limited. So we have equity shares, then we have these preference shares which we are going to issue. So preference shares will be this over here. P Limited will issue 1125 preference shares of rupees 100 each. So it will be 1125 into 100. Okay. Okay, so we have equity shares and we have preference shares. Hmm. So, and after that, we are going to do a total. So this is basically your purchase consideration. 3,93,750 rupees. Okay, that's clear, everyone?
Yes.
Is that clear? That how we have calculated purchase consideration in exams now. This much have 2 marks. If it is a 10 marks question, 2 marks will be for purchase consideration. 5 marks will be for entries. Remaining marks is for preparation of balance sheet. This is how the breakup. So 2 marks thing is this calculation of PC. Okay. Now journal entries. Now we'll be recording journal entries in the books of. Very surprised that all of you are not having questions in this chapter, because usually students have questions in this chapter. Nonetheless, we will solve it. Okay, so first entry will be that when we are recording the purchase. So when we are recording the purchase, what is going to be the entry? Business purchase account debit, correct? To liquidator of which company? Q Limited or P Limited? Business purchase account debit. Business purchase account debit, which is 3 lakh, your PC is basically 393750. Okay, so same thing. 393750. 393750. Okay. Two liquidators account. Two liquidator of Q Limited, because we are purchasing Q Limited. Okay. Then second entry, when you will take over the assets of that company of Q Limited. So you can see the assets over here. Plant and machinery, land and building, inventories, trade receivables, cash and cash equivalents. All the assets, and then liabilities. 10% debentures, trade payables, and what? First you have to write all of this. Okay. So we'll make this entry. We'll record all the assets. Plant and machinery, land and building, inventories, trade receivables, cash and cash equivalents. 1,80,000. 1,73,250, 1,23,750, and 63,000. Okay, so these are basically the assets you have taken over. Now, so you basically you have to see it from the balance sheet. Okay, if you see, I'm taking these figures from this balance sheet, from the asset side of Q Limited, all the assets, plant and machinery, land and building, inventories, trade receivables, and cash equivalents. The total should be 7,87,500. Let's check it. Let's check it if I don't know why my Excel is not showing the total. 7,87,500. That's okay. Okay, now we are going to take over the liabilities of that company. So let's see the liabilities. It is trade payables and debentures. Trade payables. How much? 27,000. Okay, so we have general reserve, statutory reserve. No, 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 no. We don't need to take it. Fine. So these two assets will be there, liabilities will be there, and we are going to record that purchase consideration. So we usually record our purchase consideration over here on the credit side, because initially we have debited it. So definitely we are going to credit it now to business purchase account. So that is 393,750. Okay. So we're just going to see what's the difference. If that difference is coming on the debit side, we are going to write it as goodwill. Okay. And if it is coming on the credit side, we are going to write to capital reserve. So over here, we can see that the balancing figure will come on our this liability side. So it should be 6,600. Difference basically. It is basically the difference. I'll show you. This minus sum of this. Okay. Uh-oh. Hold on. Something is wrong. 30020. Okay. This is 27,000 now. 60 is 6,660. Okay. No goodwill. If this difference was coming on the debit side, then we would have recorded under goodwill. Okay. So this is the entry for recording the purchase of that company Q Limited. Okay, now we are going to pay off the purchase consideration. So when we are paying off the purchase consideration, first we are going to debit this account, which we have earlier credited, liquidator of Q Limited. So liquidator of Q Limited. It is 3,393,750. Okay. To share capital, what we are going to issue, you can see from that working of consideration. We are issuing equity shares and preference shares, right? So to equity share capital, then to preference share capital. Okay, so that's how you're going to issue the purchase consideration. Now, it was decided that when the company will take over this company, P Limited will take over Q Limited. So, whatever debentures Q Limited is having, they will be issued equivalent number of debentures in the new company. So, we have to record that as well. So, what we are going to do is we are going to debit that 10% debentures. We are going to debit 10% debentures, that is 27,000. Okay, and then you will credit the debenture 9% debentures of the new company. It was because this company is having 9% debentures. Okay, 9% is basically the interest rate. So 9% debentures, old debentures are written off, new debentures are issued. Okay, this much. And then after that, for all these statutory reserves, like if you see Q Limited is having certain statutory reserves of 148050, that is also recorded. The thing is, they are recorded separately. They are not recorded in that this entry. Okay, they are recorded separately. So what we are going to do, we are going to record it as two statutory reserve. And whenever the statutory reserves are recorded, whatever like what you're going to debit is this account. There is a new account. You should memorize this name, amalgamation adjustment account, that is used to record any sort of capital reserves or statutory reserves when you are taking over another company. So that company's reserves will be recorded under amalgamation adjustment account. Fine. After this, you will be preparing a balance sheet, which is exactly the same. You are going to record all the assets, liabilities, okay, whatever balance. So you will be recording, I'll tell you, these accounts, these accounts, these accounts, this account, and this account. So when you will record this, all of these, you will be getting a balance sheet because we have time limitation. We are going to, I'll show you the kind of balance sheet which is going to be prepared. Just give me a moment. So you will get a final balance sheet just like this. Recording all the plant and machinery, land and building, inventories, trade receivables, amalgamation adjustment, and then your equity shares, whatever you have issued, preference shares, capital reserves, trade payables. So this is going to be your final balance sheet post amalgamation. Fine. So any doubt in this? Do you have any questions, any doubt in this particular thing? Any questions? Any doubt? No questions? So,
No, ma'am.
okay. So with this, basically your unit number 7 comes to an end. What I would suggest you is please go through your that study materials. A lot of questions are there that will basically enhance your conceptual knowledge of this chapter. Practical questions, solved questions, everything is there. Try to go through those questions and please let me know if you have any doubts. Though it is the last session, but yes, we can be connected through your coordinator. So if you have any queries, please you can send us your queries. We'll try to resolve them at the earliest. Okay, so let's, I think, begin with the last chapter, which is your module number 8. Holding company balance sheet. Right? Do you understand, anyone? Do you understand what is holding company and subsidiary company? Hmm?
Like
Any?
a company,
Come again, I'm sorry. Maybe
uh,
my
a big company.
a big company.
Yeah.
Okay. And and what's the subsidiary company? And what is a subsidiary company? Okay, no problem. We'll discuss it. No problem. So what is happening in holding companies balance sheet? Now this is actually a very huge topic, but in your syllabus that much is not involved. Just need to have the basic understanding of what is basically a holding company and subsidiary company, and very basic questions of what should be covered in your in this particular chapter. I'll just give me a moment. I'll just see the SLM that what sort of questions are there. Very basic questions. Okay, so first of all, let's understand what is the concept of your holding company and subsidiary company. So, primarily, a holding company is a company that has control over another company. So, out of the two companies, holding company is usually the bigger one. Okay, and subsidiary is usually the smaller one. So, holding company is a company that has control over another company, and that another company which is getting controlled, it is called a subsidiary company. Okay, so holding company is a company that has control over another company called a subsidiary company, and control is usually established by owning more than 50% of the equity shares or having the power to make key management and financial decisions of the subsidiary. So a subsidiary company, now what is a subsidiary company? It is a company that is controlled by another company. Okay, so this conceptual understanding is important because that will be a part of your MCQ subjective questions. These types of questions are definitely asked. What is a holding company? What is a subsidiary company? In MCQ form also various questions will be framed. Okay, so if you see all these companies issues, they are covered by Companies Act 2013. Now we're talking in reference to India. Okay, so in India we have this Companies Act 2013, which covers all these regulations of companies. Fine, that how transactions will be done, and what are going to be the rules, what are going to be the process, everything. Okay, now as per that act, they have given a definition of holding company. It says that a company is a holding company of another company if it has control over that company, uh, and that control can be um, achieved by various things. First can be that you are the owner of more than 50% of the voting power or equity shares of that company. Then you become the holding company. For example, if in your company I have 55% stake. So I am a holding company for you. Okay, so owning more than 50% of the voting power in that company, that will make you a holding company, and controlling the composition of the board of directors. That is the ability to appoint or remove directors. Then having significant influence over business decisions, that is directly or indirectly. That is again a holding company. Then we have subsidiary company. So our company is considered a subsidiary company if another company, it holds more than 50% of its equity share capital, or it control its board of directors. Okay, so that is a particular scenario, that what is a subsidiary company? A company is considered a subsidiary if another company holds more than 50% of its equity share capital. Okay, so that is a subsidiary company. Then what are basically the, you can say, uh, characteristics of these companies? So holding company, it's very simple. It owns majority shares in the subsidiary company. Then it controls strategic decisions of that subsidiary company. It can influence financial and operational policies of that company. I think if you've ever heard about subsidiary company, or if you have read about these things somewhere, then you must have an understanding, because it's very general things, like what all holding company can do. It will own majority shares in that company, it will control the decision making powers, it can influence financial and operational policy, preparing consolidated financial statements including subsidiary accounts. So these are basically the key features of holding and subsidiary companies. Then subsidiary company, it operates as an independent entity but is controlled by the holding company. So it can have its own board of directors, but decisions are influenced by the holding company. So subsidiary company, it is more or less controlled by your holding company. So it may have its own shares in other companies, but it cannot hold share in its holding company. So there are various things. Okay. So for example, if you see that Reliance Industries Limited, that's a bigger company. That's the holding company. And Jio, it is its subsidiary. Reliance Jio is the subsidiary of Reliance Industries Limited. So Reliance Industries Limited, they own more than 50% of shares in the Jio, making it a holding company, while Jio is its subsidiary. Okay. Similarly, in case of your Facebook and Instagram also, and WhatsApp also, so Facebook is the holding company, and the Instagram and WhatsApp, these are their subsidiaries. Okay. So Meta is the holding company, and the remaining are your subsidiary companies. Fine. So let's come back to the PPT. A meaning of holding company. So a holding company is a company that owns the majority of the voting stock of other companies, known as subsidiaries. Then the prime purpose of a holding company is to own and control other companies, often with the goal of managing a diverse range of businesses or assets. Fine. So that is the prime purpose of a holding company, that it is there to own and control other companies, and often with the goal of managing a diverse range of business assets, or you can say companies. Okay. Then a holding company, it does not typically engage in the day-to-day operation of its subsidiaries, but rather holds ownerships, and it can influence decisions through its voting powers, because it has a certain say in the subsidiary companies, that their opinion is mattered because they are owners of a majority shares. Fine. So holding company, it does not typically engage in the day-to-day operations of its subsidiaries, but it holds ownership and it influence decisions through its voting powers. Then subsidiary company. So it is a company that is owned or controlled by another company, and it is known as the parent or holding company. So the subsidiary may operate independently or be integrated into the overall business strategy of the holding company. The holding company, as the majority shareholder, has the authority to make decisions for the subsidiary, such as appointing board of directors and influencing major decisions. So these are basically the powers a holding company has in the subsidiary company, that it has the authority to make decisions like appointment of board of directors and whenever they are taking any major business decisions. So this image can actually explain you the relationship between the holding company and subsidiary company. So you can see there is a company A, which is a holding company, and there's a company B, which is a subsidiary company, and then this company A is the owner of maximum shares of company B, and it controls company B. Okay, so that's the scenario with holding companies and subsidiary companies. Okay, so this is a small example. Just imagine a company A, which is a holding company, and it owns 80% of the voting stock of company B. Then company B is then considered a subsidiary of company A, and company B may operate in a specific industry or region, while company A may have ownership interests in several such subsidiaries, each with its own business activities. Okay, so this is the thing. Now, what are the reasons why we are getting into this mess of holding and subsidiary? Because there are certain benefits which are there because of this relationship of holding and subsidiary companies. So, holding companies, they are formed for various strategic, financial, and operational reasons. So, some of the common reasons for creating holding companies, it include asset protection, risk diversification, and tax planning. Okay, just give me a second. Okay, so asset protection. So holding companies, they can provide a layer of protection for the assets of individual subsidiaries. So since each subsidiary is a separate legal entity, the financial troubles or legal issues of one subsidiary generally do not directly impact the assets of other subsidiaries or the holding company itself. So risk diversification. So by holding ownership stakes in multiple subsidiaries operating in different industries or geographical locations. So a holding company can spread its business risks. Diversification, it helps mitigate the impact of poor performance in one sector by relying on the success of others. Then we have tax planning, that holding companies can be used for tax optimization. They may take advantage of favorable tax regulations or jurisdictions, and the structure can allow for more efficient tax planning and management of income, expenses, and losses within the group. So these are basically the reasons for, there are few more reasons like centralized management and control, that a holding company can facilitate centralized management and any control over subsidiaries. Like for example, Reliance Limited, it is controlling all of its subsidiaries and it is having one company which is holding the entire group. So there's a centralized management and control. Then acquisitions and mergers. So holding companies are often used as a vehicle for mergers and acquisition, and they can acquire other companies and integrate them into their structure, leveraging synergies and creating more diversified corporate entities. So then the last is your financial engineering, that the holding companies can engage in a financial engineering by leveraging the combined financial strength of their subsidiaries. So this may include obtaining favorable financing terms, negotiating better deals with suppliers, or accessing capital markets more effectively. Okay, so this is basically reason for forming holding companies. So these are basically the advantages: risk diversification, asset protection, tax benefit, centralized management, mergers and acquisitions, financial efficiency, succession planning, brand management. Okay, then disadvantages of forming holding companies. So complexity and overhead, regulatory compliance, cost of formation, loss of independence, communication challenges, limited flexibility, financial interdependence, tax complexity. So these are basically the disadvantages of forming holding companies. Then we have minority interest. So minority interest, it is also known as non-controlling interest. It refers to the portion of subsidiaries equity that is not owned or controlled by parent company. So I think this will you will better understand when you will solve a question. Okay, so what we can do is let me share. I hope all of you have a copy of the SLM. Seher, Karima, do you guys have copy of SLM?
No, ma'am.
So you will request that from the course coordinator that you should get a copy of SLM, because that's really important, and that will also help you in practicing. I don't know why you have not requested, but please connect with the, just a second. Hmm. This is your SLM copy. You should ask from the course coordinators. That will help you. Okay, that's very important for your exams preparation also. We'll come to this chapter of, so you can see there are a lot of case studies and solved questions also in your SLM. Holding company's balance sheet. We have done this explanation part. We have done this image. So you can see there are these examples also. Reasons we have done. Advantages and disadvantages. So you can see there is a detailed explanation over here. Okay, so there's a detailed explanation that is, so this is going to really help you while you're preparing for exams. Okay, advantages and disadvantages of holding companies, risk diversification, asset protection, tax benefit, all of these points. Okay, then disadvantages also, that it relates, that it will result into complex and little bit complex, because you have to then do an accounting differently. Okay, so that concept is, that's why holding and subsidiary relationship become little difficult, because accounting is not very similar to what we do earlier. Okay, then regulatory compliances. So each subsidiary may be subject to different regulatory requirements. Now, when they combine, there is two set of regulations which you have to follow. Fine. Then cost of formation. So yes, establishing and maintaining a holding company structure. It can involve legal and administrative cost. Okay. Then loss of independence also, because subsidiaries will lose some degree of independence as the holding company exercises control over major decisions. So this can lead to conflicts if subsidiaries' interests diverge from the overall corporate strategy. Okay. Then Amazon subsidiaries. So you can see this is the case with Amazon. So it has so many subsidiaries. Okay. Then there are certain relevant provisions of AS 21 which are followed. AS 21 is actually Accounting Standard 21, which relates to consolidation of financial statements. That is used for, you can say, monitoring of this particular concept. So this AS 21 applies to the consolidated financial statements of a group with the parent and its subsidiaries. Okay, it helps in having a uniform accounting policies. It helps in giving guidance when there are certain adjustment entries which need to be done. Then for creation of goodwill or capital reserves. So the excess of the cost of the investment over the parent's portion of the equity of the subsidiary at the date of acquisition, it should be accounted for as goodwill or capital reserves. Okay. Then there is concept of minority interest, which I've already told you that uh, for example, if you see the full company, it is 100%. 80% is controlled by the holding company. Okay. So the balance remaining 20%, that is your minority interest. Okay. So minority interest basically represents the equity ownership in a subsidiary that is not attributable to the parent company. So if 80% is parent company, so the remaining 20%, which is not the parent company, that is minority interest. Okay, so now let's see these questions. That is why I have opened that PDF. ABC Limited, it owns 80% of XYZ Limited. Both companies have the following balance sheet. So you can see ABC Limited, it is having assets of 10 lakh, liabilities of 6 lakh, and equity of 4 lakh. Fine. Oh. Then in case of XYZ Limited, you have assets of 5 lakh, liabilities of 3 lakh, and equity of 2 lakh. So now you need to calculate the minority interest in the consolidated balance sheet. So ABC Limited, it owns 80%, so minority interest is 20%. So minority interest is equal to 20% of rupees 2 lakh, fine, which is 40,000. Okay, so that is your minority interest. Okay. Let's move to the questions. This is all theory. I think you can definitely read all of this. So let's solve a few questions. Let's solve this one. I'm solving questions from your SLM only so that it becomes easier for you to later refer it. Okay. So the balance sheet of A Limited and B Limited, they are presented as of 31st March 23. You can see liability under your assets, you have fixed assets and under investments, A Limited is having investment in B Limited. That means under investments of A, you will be having shares of B Limited. And if you see B Limited, if you see the share capital, that share capital basically belongs to A Limited. That's the relationship. Okay. So what you have to do, you have to draft a consolidated balance sheet as on 31st of March 2023. Fine. So how will you do that? Let's draw a consolidated balance sheet. Consolidated balance sheet of AB Limited. Mhm. Very simple. Liabilities amount. Assets amount. Okay. Hmm. So fixed assets. The first thing which you will write is fixed assets. So for A Limited, it was 8 lakh. I'm just writing it like this. For B Limited, it was again 8 lakh. So total assets is 8 plus 8, 16 lakh. So we will write 16 lakh. Now investment in shares of B Limited. So this is something like intercompany investment. So that is no point of writing it over here. Okay. Now we will write share capital. Share capital, that is equity shares of rupees 10 each. So that is going to be 8 lakh. Okay. Then your reserves is given 2 lakh. Okay. And then your creditors again 6 lakh. Okay. So you can see the total will come out to 8 plus 2 plus 6. That will come out to 16 lakh. Absolutely right. Okay. So this is your consolidated balance sheet of AB Limited. Is it clear? Simple? Is it clear, everyone? Hmm. Let's solve one more question. Okay. So let's solve one more question. The balance sheet of M Limited and N Limited are presented as of March 31st, 23. So you can see fixed assets 2.28 lakh for M and 2.4 for N Limited. Then investment, so in shares of N Limited 100%, like you are in this M Limited has invested 100% into N. Okay, so it is 1,92,000 because actual this investment it is over here under your 2,40,000. Sorry, 1,80,000. Fine. So 12,000, I believe it will be the market appreciation. The face value is 1,80,000 and the remaining is your market appreciation. Then if you come to the liability side, we have share capital, we have reserves, and we have creditors. And we need to draft a consolidated balance sheet as on 31st of March 2023. So first what we are going to do, we are going to compare that like what is the investment and what is the basically the difference between the investments and the book value. So if you see um, the value of this share value first solution. Okay, so we'll see that the value of investment is 1,92,000. Valuation of investment is 1,92,000. Okay, let's see what is the face value. Face value of the investment. It is how much? 1,80,000. 12,000 is basically the goodwill. Okay, it is known as goodwill. So the 12,000 is going to be the goodwill. Okay. Now let's see how to prepare a consolidated balance sheet. So let's make a balance sheet. Let's copy the format. Okay. Consolidated balance sheet. We will copy it. So consolidated balance sheet of MN Limited. Consolidated balance sheet of MN Limited. Fine. Assets. Let's write to reduce the font because you're not able to see the question properly. Now it is better. Yes. So first we are going to record the assets. So if you see, we have fixed assets. Fixed assets. So that is 2,28,000 plus 2,40,000 to 228,000 plus 240,000. Okay. Then investments. Investments, if you see, it is in shares of N Limited and that is for 1,92,000. So we don't record investment separately because it is already included in the share capital. So the thing is what we are going to record is goodwill, which was 12,000. You have computed it here now, that the book value and the face value difference. Fine. Now if we come, so this is your basically your goodwill for MN Limited. Now, if you see the liabilities, you have creditors, you have reserves, and you have share capital. So, if you see the share capital, you are going to record this because N Limited is going to be knocked off. Knocked off as in 1,80,000 is over here and this investment is over here. So it basically knocks off and you don't reflect the fair value then. Okay. So we have share capital of 2,40,000. Then we have reserves. Those reserves are how much? 60,000. Because if you see the investments, if you write 1,80,000 on the asset side and then you write 1,92,000 on the liability side, so 1,80,000 they automatically they kind of knock off. Okay, so eventually the balance will become zero. That is why we don't specifically show that investment in M Limited. We only show the difference, which is 12,000. So if you see 1,80,000 crossed from liability side and 1,80,000 crossed from asset side. So what is left? 12,000 on the asset side, which is goodwill. Okay, then creditors. So creditors is your 1,20,000 plus 60,000. So that comes out to rupees 1,80,000. Fine. So that total comes. Okay. So that's how your balance sheet will be prepared. You can see it's very, very easy. This questions in this chapter are very easy. I have solved a few questions, but there are, I think, two or three more questions which are given in your SLM. They're on the same pattern. Okay. Try to solve those questions. I will quickly run through those questions. Yes. You can see these are the same pattern questions which I would request all of you to please practice after the session. And if you face any difficulties, you don't understand it, you can please drop us a mail. We'll try to resolve your query. Okay. So same question, like two balance sheets will be given and then you have to consolidate it. And in most of the cases, you will be having, uh, just give me a second. I don't know if I'm sharing the PDF. Hmm. Yes. Okay, so you have to record it like this, consolidated balance sheet. You have to prepare a consolidated balance sheet each time. Fine. So there are, I think, 1, 2, 3, 4, 5, 6 questions. So you just try to solve these questions. Let's do this question, this last one. The balance sheet of A Limited and B Limited are presented as of March 31st, 23, and you have to draft a consolidated balance sheet. So fixed assets, 8,20,000 in A Limited, 8 lakh in B Limited. Then you have investment in shares of B Limited, that is 70%. So we have 5,80,000. Then under A Limited and B Limited, we have share capital, which is 8 lakh and 6 lakh. Then you have reserves, which is 2 lakh. Then we have creditors, which is 4 lakh plus 2 lakh. Okay. So let's see. Value of investment is 5,80,000. You can see this 5,80,000. Then you're saying that it is the share capital in B's book, which is 70%. So 70% of B's share capital, it is 4,20,000. So the remaining is 1,60,000. And what is the minority interest? The part which is not taken up by the holding company. That is the minority part. So you've calculated all of this and you fix it in this balance sheet. Fixed assets, goodwill, share capital, reserves, minority interest also comes on the liability side. And then you sum up the creditors. And if you give the total, it will match. So very easy. This was the most difficult question of this chapter. You can see. So it is also the easiest, I think. So easiest of all the chapters. So that's all for today's session. And with this, your entire corporate accounting, it comes to an end. Please solve the questions which were discussed in your live sessions. Go through the recordings, go through the PPTs, have a look at the study material. There are a lot of questions, MCQ solved questions that will really, really help you. And still, if you face any queries, please write to us. You can drop us a mail to the coordinators. They will try to connect us. Okay, so that's all for this session. Thank you so much. Have a nice day and please start studying. Okay, thank you so much. Bye bye. Take care.
Thank you, ma'am.